Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at HSAI, or Hesai Group ADR. HSAI engages in the development, manufacture, and sale of three-dimensional light detection and ranging solutions. Through its subsidiaries, its LiDAR products are used in passenger and commercial vehicles. Hesai Group is based in Shanghai, China. Here's the barchart.com technical opinion rating for HSAI. The bar chart rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. There wasn't much room for this, so we left it out. The market is approaching overbought territory, be watchful of a trend reversal. We don't see a trend reversal right now. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10 period or 10-month simple moving average. The monthly chart shows that HSAI is well above the moving average line, so the monthly trend in HSAI is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50 period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line is above the green line, so the daily trend in HSAI is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. HSAI is below the upper Keltner channel line, so HSAI is inside the buy zone. Since the trend is up, we want to buy a call. HSAI has 4 option chains to choose from. We're going to use the August 15 chain. Right now, the August 15 options have 34 days to expiration. Come on. Since the trend is up, we want to buy a call. Whoops. I'm sorry I said that. Let's move on. Here's the HSAI option chain for August 15. HSAI closed at 23.90 on Friday. That means any calls on the list from 10 to 22.50 are in the money. Let's take a look at the profit potential for purchasing the 25 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 25 call is 2 to 215. We try to enter near the midpoint, so we'll use 210 as the buy price. Our call option calculator shows the profit potential for this call based on HSAI price changes at option expiration from flat to a 12.5% increase in price. We can see that if the HSAI stock price is flat at 23.90 at option expiration, the 25 call will lose 100% of its value. Ouch! This is an unacceptable risk that can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 20 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 20 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the HSAI stock price is up 1%, the 20 call will lose 5.9% of its value. We want that to be break even or better, so the 20 call does not meet our requirements. Let's see if the 17.5 call will work. The bid-ask spread for the 17.5 call is 650 to 690. We try to enter at the midpoint, so we use 660 as the buy price. The 17.5 call works. If the HSAI stock price is up 1%, the 17.5 call will make us 0.6% or $4 profit. That's better than break even, so the 17.5 call is the one we'll buy. The call option purchase calculator also shows that if the HSAI stock price increases by 2.5%, the 17.5 call will make a 6% or $40 profit. If the HSAI stock price increases by 5%, the 17.5 call will make a 15.1% or $99 profit. If the HSAI stock price increases by 7.5%, The 17.5 call will make a 24.1% or $159 profit. The plus 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the HSAI stock price does not make the expected move up and remains flat at expiration, the 17.5 call will only lose minus 0.6% or minus $20 compared to the minus 100% or minus $210 loss for the 25 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the HSAI August 15 17.5 strike call and sell to open the August 15 22.5 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 17.5 call for 660 and sell the 22.5 call for 320. 660 minus 320 equals 340. So the entry price or debit cost for the spread is $340. The call option spread analysis calculator picture shows that the spread will make a 47.1% or $160 profit if the HSAI stock price declines by 5%, remains flat, or increases in price when the options expire. If HSAI is down 7.5% at expiration, the trade will make a 35.5% or $121 profit. Creating the debit spread will allow us to collect a $320 cash credit to our brokerage account for the sale of the 22.5 strike call. As we said on the previous slide, this reduces the cost of entering the spread to $340. Here's a note regarding earnings reports. The next HSAI earnings report is scheduled for August 18. Let's review the trades one more time. The first trade was a call purchase, said to buy to open the HSAI August 15 17.5 strike call for 660. We also reviewed the spread. The spread said to buy to open the HSAI August 15 17.5 strike call and sell to open the August 15 22.5 strike call at a debit of $340. That's it for this week's optioneering workshop. Thank you for joining us. We look forward to seeing you again next week.